Hello, my name is Magnus Petersen. This video is about long-term forecasting of international stock indices. In the previous video, we used a forecasting model on the S&P 500, 400, 600 and the Nasdaq 100, and it worked quite well on historical data. So in this video, we're going to try the same for international stock indices. One is for developed markets in Europe, another for Germany, another for Austria, and for emerging markets, that is Latin America, emerging Europe, Africa, and mostly Asia, and then another index only for China. It is very expensive to obtain data for international stock indices, but I was so lucky that the data company Morningstar provided me with historical price-to-sales ratios for many international exchange-traded funds, or ETFs, which track international stock indices. So I used these price-to-sales ratios and converted them into sales per share data for 5 ETFs that track these international stock indices for Europe, Germany, Austria, emerging markets, and China. Before you watch this video, you really need to watch the previous one as a minimum. And it might also be a very good idea to watch the one that goes over the theory of how this forecasting model works. In this video, I will only very briefly recap what the mathematical model is. So if we define the total return as a number of shares at time step t multiplied by the share price at that time step t, then over time we will reinvest the dividends without paying any taxes, so the number of shares will increase. Then we define the annualized return as the total return for some time step in the future, t plus a number of investment years, divided by the total return at the beginning time step t, and this is taken to the power of 1 divided by years to get an annualized number, and then we subtract 1. One of the previous videos showed how to use this definition of annualized return to get these formulas down here for the mean annualized return, which is defined as some number a divided by the price-to-sales ratio at time step t to the power of 1 divided by years, and then all of this minus 1. Because the annualized return is a stochastic number, that is, it varies randomly, it is also useful to estimate the spread around the mean as the standard deviation, which is done by this formula, and it's almost the same. It just uses another number b, and then it doesn't subtract 1 at the end here. The previous video about the theory of these formulas and how they are derived showed that the number a can be estimated from the mean dividend yield, the mean sales per share growth, and the mean price-to-sales ratio. And similarly, the number b can be estimated from the standard deviation of the dividend yield, sales per share growth, and the price-to-sales ratio. Okay, so let's try and use this forecasting model. And first we will try it on the Europe Developed Index, which is tracked by the ETF with ticker symbol VGK. And this index contains more than 1,300 stocks, and it has a very low annual turnover, which means that each year it's a very small number of stocks that get replaced in this index. Let us first consider the price and total return of the VGK ETF, and it is shown in this plot here, which goes from the year 2005 to 2019. And the yellow line is the share price, and the blue line is the total return, so that is the share price with the reinvestment of dividends without having to pay any taxes on those dividends. One of the important components of the forecasting model is the price-to-sales ratio and how that varies over time, and this I often call the revaluation of the stock or the stock index. As we can see from this plot, it has varied roughly between 0.5 and 1.4, and the mean was around 1.0, which is around here. Another important factor of the forecasting model is the sales growth, and we plot that for the Europe index here, and this looks quite erratic, and the lowest was around minus 22%, and the highest was around 18%, and the mean was around 0.0%. But it's not a problem that is very erratic. It goes up and down, so it has high sales growth, low sales growth, high sales growth, low, high, and so on. It's not a problem when we are considering long-term returns, for example 5 or 10 years. What matters for the forecasting model is that the mean sales growth over every, for example, 5-year period is roughly the same no matter what 5-year period that we take. So if we take this 5-year period here to here, or we take a 5-year period here from here, they just need to have roughly the same mean sales growth. Then we can use the forecasting model on this historical data. Now, of course, whether we can also use the forecasting model in the future depends on whether the mean sales growth in the future is roughly the same as the mean sales growth in the past. And that is really a qualitative assessment. So the third component of the forecasting model is the dividend yield, and this is usually the least significant part of the forecasting model because it is usually fairly low. But in a situation where we have a stock or stock index where it has low sales growth, then the dividend yield can be important. So this plot here for the Developed Europe Index shows that the dividend yield ranged between 1.4% and 11%, and the mean was around 4%, which is around here. So let's try and use the forecasting model on the Developed Europe Index. And you should see the previous video for US stock indices for a more detailed explanation of what this plot shows. I will just explain it very briefly here. So what the blue dots represent are the actual historical one-year returns of the ETF with the ticker symbol VGK, which tracks the Developed Europe Index. The baseline is the dashed black line here, and it represents the mean annualized return. So it is just the mean of all these blue dots here. The solid black line represents the forecasted mean annualized return, and the green region is 1 standard deviation around that mean, and the red area is 2 standard deviations. And these are the forecasting formulas using the historical financial data to get the numbers A, which is 1.08 in this case, and the number B, which is 0.218 in this case. So this formula here is for the solid black line here, and this formula here is used for these regions here, the green one and the red one. We are using 2 statistical measures to assess whether this is a good or bad fit. We have the mean absolute error, and we have the R squared. And what both of these show us is that the forecasting model is only slightly better than the baseline. So let's try and look at 2-year annualized returns. So again, the plot shows us the actual 2-year annualized returns for the historical data, and the solid black line shows us the forecasting model using the historical mean dividend yield, mean sales growth, and mean price to sales ratio. And it looks like a lot of this fits within 1 standard deviation. And we can also look at the statistical measures. So the R squared is 0.48, which means that roughly half of the variance in the data is now explained by the forecasting model. And that is actually quite impressive for only 2-year annualized returns. If I remember correctly, this was even better than for the S&P 500. So let's try and look at 5-year annualized returns. And now we can see on the plot that mostly all of the actual 5-year annualized returns are contained within 1 standard deviation of the forecasting model. And this is also shown by the high R squared value of 0.79. And this is actually quite remarkable for 5-year annualized returns. So let's try and look at 10-year annualized returns. And we have it in this plot here. And this looks to be a very good fit. The actual data points, the blue points, are very tight around the forecasted mean, and the R squared value is 0.86. However, this is actually data for a fairly short period because we're considering 10-year annualized returns between 2005 or 6 and 2019. So the last start date is for 2009, so only roughly a 3-year period. So it's actually not very much data, and we should be careful about not generalizing this too much. In the previous video, I explained that some of the noise that we see in the data is because of bubbles and crashes. And one way to sort of smoothen out the effect of bubbles and crashes is to take the average of, for example, all 3 to 7 year investment periods instead of just considering fixed 5-year investment periods. And when we do that for the Developed Europe Index, we get this plot here, which is a quite good fit with an R squared value of 0.82. So now let's look at the stock index for Germany. And this is tracked with the ETF with the ticker symbol EWG, which currently contains 65 stocks and has a very low annual turnover, so only few of these stocks get replaced each year. So let's first look at the price and total return, and we have it in this plot here, which shows the price between 2002 and early 2019 as the yellow line, and the total return, which has the dividends reinvested without having to pay any taxes, is shown as the blue line. So let's look at the price to sales ratio for this period, and it is shown in this plot here. it ranged roughly between 0.3 and 1.1, and the average was around 0.7, which is around here. Once again, an important component of the forecasting model is the sales growth, and this plot here shows the annual sales growth between 2002 and 2019. There is a strange spike here, but that is probably okay because we are mainly interested in the mean sales growth and whether this plot here is showing some kind of cyclical tendency and mean reversion, and it appears to be doing so. And the mean sales growth was around 2.3%. So even though in 1 year it could have a sales growth of 20% like here, or something like 30% here, or maybe 25% here, it is counterbalanced by a decline in sales growth. Here it is maybe something like -17%, -21%, -25% here, and so on. But it seems to be roughly cyclical with a reversion to the mean of around 2.3%. So now let's look at the dividend yield, and that has ranged between 0% and roughly 5%, with an average around 2%. So now let's try and use the forecasting model with these averages for the historical dividend yield, price to sales ratio, and sales growth. And this plot shows it for 1 year annualized returns. And as we can see from the negative R-squared value, there is a very poor fit because the model is non-linear and the data has very high variance. So let's try and use a forecasting model for 2 year annualized returns. And the plot shows quite a lot of dispersion around the forecasted mean, but the R-squared value tells us that a fairly decent amount of the variance in the data is actually captured by the forecasting model. And we can try and look for 5 year annualized returns. So now the plot shows a tighter fit around the forecasted mean, and indeed we have a higher R-squared value of 0.68. We can also look at 10 year annualized returns, but again we have the problem that the start dates will only range between 2003 and 2009, so a 6-year period roughly, because the last 10-year period has to go from 2009 to 2019, which is the end of our dataset. And if we plot it, we see a fairly tight fit around the forecasted mean, and the R-squared value is 0.84. But just keep in mind that we don't have a lot of data for this plot. And once again, we can try and average all 3 to 7 year investment periods to smoothen out bubbles and crashes. And then we get this plot here, which has a very good fit around the forecasted mean with an R-squared value of 0.82. Now let's look at the stock index for Austria. And we will consider the ETF with the ticker symbol EWO, and it currently contains 27 stocks, and it has a moderate annual turnover, so that each year some of these stocks will be replaced in the index. Let's first look at the price and total return, and we have it in this plot here, which goes between 2002 and 2019. And again, we have the share price as the yellow line, and the total return, where dividends have been reinvested, is the blue line. Now let's look at the historical price to sales ratio for this period, and it is shown in this plot here. And we can see that it started very low around year 2003, and then around year 2007 it reached its max at around 2.0, and then in the financial crisis it went back down, and then it has zigzagged a little since then. And now let's look at the sales growth, which is another important factor of the forecasting model. And the plot shows us that it has gone up, down, up, down, up, down quite erratically. I don't know if I want to call this cyclical, but again, the important thing for the forecasting model is that when we consider, say, 5 or 10 year periods, that the mean sales growth for each 5 or 10 year period is roughly similar to other 5 or 10 year periods. That's what is important, and not whether it fluctuates wildly year to year, because that's not what we're trying to forecast. We're trying to forecast long-term returns. And even though the range is quite wide, so the highest annual sales growth was maybe 45%, which is right here, and the lowest was a decline in sales of about 30%. But on average, the annual sales growth has only been around 0.8% during this roughly 15-year period. Now let's look at the dividend yield, and the plot shows that it has ranged roughly between 0 and 10%, and the mean is around 2.2%, which is around here. So now let's try and use a forecasting model with this historical financial data. And as usual, for 1 year annualized returns, we get a very poor fit with an R-squared value of minus 0.51. So let's try and look at 2 year annualized returns instead. And we have it in this plot here. and the actual returns are spread around quite significantly around the forecasted mean, so the R-squared value is 0.19. But when we consider 5-year annualized returns, the fit gets a lot better with an R-squared value of 0.50. And as we can see on the plot, the actual historical data as the blue dots starts to fit the solid black line better. And if we look at 10-year annualized returns, the fit gets even better. The plot shows us that the blue dots fit a lot tighter around the forecasted mean, and the R-squared value is 0.88. But again, we have the problem that the last start date for a 10-year period is in 2009, so the start dates only range between 2003 and 2009, so it's not a lot of data, it's about 6 years, and so this result should be taken with a grain of salt. Once again, we can consider the average of all 3 to 7 year periods, and we get this plot here. It's not a super tight fit. For example, here it looks like there's actually 2 trend lines, and here. And that means that the R-squared value is 0.65, which is still pretty good, but it's not super tight. Now let's look at the index for emerging markets, and this is tracked by the ETF with the ticker symbol EEM, and it currently contains about 950 stocks from Latin America, emerging Europe, Africa, Middle East, and about 75% of the stocks are from Asia. So let's start by looking at the price and total return. And between 2003 and 2019, we have the share price shown as the yellow line here, and the blue line shows the total return, which is the reinvestment of dividends. And as we can see, from 2003 to 2008, it increased about 5-fold. And then we had the global financial crisis, where it crashed almost back to the same level that it started at. And then it recovered somewhat, and then it has been more or less zigzagging since then. So let's take a look at the price to sales ratio for emerging markets. And we have it in this plot here. And it ranged from 0.9 at the beginning. Then it went up to 2.4 before the global financial crisis. And then it dropped down to about 0.9 again. And then it has been zigzagging since then. So let's look at the sales growth. And the plot shows us that it was about minus 20% here, plus 60% here, minus 25% here, plus 25% here, minus 15% here, plus 50% here, and that it has been a bit less volatile since then. So it looks like there are these 2 phases, one with very high swings in the sales growth and one with lower swings. And maybe this is the reason that the forecasting model doesn't fit so well, as we will see in just a moment, because there are these 2 phases and we just use the average sales growth for the entire period, which was around 5.7%. And if we scroll back up to the price to sales ratios, we also see kind of 2 phases. The first phase where the average price to sales ratio is maybe 1.6, and the second one where the average is maybe 1.2. So let's just look at the dividend yield as well. And this ranged between 0.6% and a bit more than 4%. And the average was around 1.9%, which is around here. So let's try and use the forecasting model where we just use the averages for this entire historical period and see how that fits the annualized returns. So this plot here shows it for 1-year annualized returns. And as you can see, it's all over the place and it's a very poor fit. And the R-squared value is minus 0.34. Now let us consider 2-year annualized returns. And the plot still shows a quite poor fit, and the R-squared value is still negative with minus 0.15. So let's look at 5-year annualized returns, and this actually starts to look better. It looks like there is a trend in the data here, but our forecasted mean is a bit too low. But it also has a large cluster of outliers down here, which is perhaps another trend. And I am guessing that this is maybe the 2 different phases that we saw. And because we are trying to use one forecasting model for essentially 2 different phases of this index history, it tries to make a compromise between these 2 phases. And that results in that overall, it's actually not that great a fit. And the R-squared value is minus 0.57. Now let's try and look at 10-year annualized returns, and this looks somewhat better, and the R-squared value is now 0.53, But again, you have to remember that the last start date is in 2009, which means that we are only considering start dates between 2004 and 2009, so a 5-year period, which is not a lot of data. So you should perhaps not consider this to be a completely reliable result, and be careful when using this forecasting model to predict the future. We can try and consider all 6 to 10 year periods and take the average annualized return of all those. And then we get this plot here, which has an R-squared value of 0.76, which is a very good fit. But again, it really only covers start dates between 2004 and 2009, so a 5-year period. Now, if we consider 3 to 7 year periods instead, which is what we will be comparing to other stock indices, then we have this plot here. And again, we see kind of two trends. We see one that our forecasting model has almost captured quite well. And then we see this big cluster of outliers down here, which is perhaps another trend line here. And overall, this means we have a poor fit to all of the data with an R-squared value of minus 0.03. Now, I just want to go back up to the sales growth here for a moment, because if you want to invest in this index today, it's hard to know whether the next 5 years is going to look like the last 5 years or whether it's going to look like these 5 years here. And similarly, if we look at the historical price to sales ratio for this emerging market index, then it's hard to say whether the next 5 years are going to look like the last 5 years or the 5 years here. And if we can't predict the mean price to sales ratio and the mean sales growth, then the forecasting model doesn't work. So let's try and look at a stock index for China. And this is tracked by the ETF with the ticker symbol GXC. And it contains about 360 stocks and has a very low turnover of these stocks. And we can start by looking at the price and total return, which is shown in this plot here between 2007 and 2019. So this is an even shorter data period than we had for the other stock indices. And again, the yellow line is the share price, and the blue line is the total return when we are reinvesting the dividends without having to pay any taxes. So let's look at the price to sales ratio for the China index. And the plot here shows kind of similar tendencies as for the emerging market index, but we only have a shorter data period here. So it started quite high before the global crash in 2008 and 9, and it peaked at 3.5. And then in the financial crisis, it dropped to 1.0, and then it recovered above 2, and then it has zigzagged since then. So again, there are kind of two phases here that are split somewhere around year 2012. And prior to that, the mean price to sales ratio was maybe around 2. And after that, it was maybe only 1.4 or something like that. So when we're using the mean price to sales ratio for the entire period, it was around 1.5. We will expect that it matches the last phase better than it matches the early phase here. So let's look at the sales growth, and we have it in this plot here, and it ranged between minus 10% and plus 50%. And again, it appears that there were almost two phases, with the dividing date being around year 2014. Prior to that, it zigzagged quite a lot. And after that, we had this huge valley here for several years, and then a peak here. So again, when we take the average sales growth for the entire period, which was around 9.0%, is probably going to be more representative of this period here than of this period here. And let's also look at the dividend yield, and it went from almost 0 up to 5%, and on average it was around 2.1%, which is around here. So let's try and use a forecasting model where we take these averages for the entire period. And as usual, we have a very poor fit for 1-year returns with an R-squared value of minus 0.63. For 2-year annualized returns, we still have a very poor fit with an R-squared value of minus 0.35. And for 5-year investment periods, it looks like it's starting to get a little tighter around a trend line here maybe. But there is another trend line down here, and that means the overall R-squared is a negative 0.85. We can also try this for 10-year annualized returns, and it looks like this, and it has a fairly decent fit with an R-squared of 0.66, but the data period is only between 2008 and 2019, so the start dates for 10-year periods range between 2008 and 2009, which is only roughly 1 year. So this is a very small amount of data, and this result here should not be considered reliable at all. We can try and smoothen out the effect of bubbles and crashes, by considering all 3 to 7 year periods and taking the average annualized returns of those. And then we get this plot here, and it looks like it is kind of forking or splitting so that there is a trend line here, which the forecasting model has fit quite well. But then there is another trend line down here, which has a poor fit. So the overall R-squared value is only 0.15. So in the previous video, we had 4 stock indices for United States. In this one, we had 3 stock indices where we had good fit of the forecasting model. That was for developed Europe, it was for Germany, and it was for Austria. So we could try and make a portfolio strategy which would sell the expensive index and buy the cheap ones. But in order for this to work, they need to have low correlation so that they are cheap and expensive at different points in time. So now we will study the correlation, and we will just take all of the indices, both the American ones and the international ones, even the ones for Asia and emerging markets, which didn't fit the forecasting model very well. And we have this table here of the correlation coefficients. And remember that a coefficient of 1 means that it's a perfect correlation, so that the price to sales ratio is always high or low at the same time. And of course, the S&P 500 has a perfect correlation with itself, and the S&P 400 has a perfect correlation with itself, and so on. A value of -1 means a perfectly negative correlation, so that when one stock index has a high price to sales ratio, another stock index always has a low price to sales ratio, and vice versa. A value of 0 means that there's no overall correlation, but that number can be misleading, as we will see in a moment. We see from this table that emerging markets had practically no correlation with the S&P 500, and the China index even had a slightly negative correlation with the S&P 500. Unfortunately, the forecasting model had a very poor fit, so I'm not sure you want to use that forecasting model when building a portfolio strategy for these particular indices. So let's ignore those and consider the other 3 international indices instead. So we have for developed Europe here, we have for Germany here, and we have for Austria here. And we see that developed Europe has a quite high correlation with the American indices. And Germany also has a high correlation with the American indices. But Austria has a low correlation of 0.21 roughly with the S&P 500 and the S&P 600. So let's try and make a scatter plot here, which shows the price to sales ratio for the S&P 500 on the x-axis and the price to sales ratio for the Austrian index on the y-axis. And what we see here is that there are 2 trend lines, one here and one here. The overall correlation coefficient was about 0.2, but that is misleading because for different periods of time, these 2 indices have actually been highly correlated. I think if we were to color code these blue dots here for the date of each blue dot, we would find that this trend line here is for one period in time and this trend line here is for another period in time. And that is what is misleading about this correlation coefficient, is that it tries to make an overall summary and it can be fooled by odd data like this. We can also try and make another scatter plot here with the price to sales ratio for the German index on the x-axis and the price to sales ratio for the Austrian index on the y-axis. And again, we see 2 trend lines here. So in the last video for American stock indices, I had summarized all of this statistical data, but I thought it might be more useful to compile it all into a spreadsheet. So there is a link below this video and you can click and download this spreadsheet here. And we have 2 pages, one with a description. So first, it just very briefly goes through the mathematical formulas and the theory behind it. And then there are instructions on how to use this spreadsheet. And then there are links to the Python notebooks and the videos. So if we go to the second page of the spreadsheet, we see several boxes. The first one on top has the price to sales ratio for today. So the intention here is that you click the links. For example, this one here, VGK. We click it and we get to this page right here for the Vanguard FTSE Europe Index Fund with the ticker symbol VGK. Then we scroll down and find this line here that says price to sales ratio. And we can see that it has a value of 1.10. As I mentioned in the previous video, this is a little confusing because it says right here it is as of the end of March 2019. And then it says it is forward-looking based on historical data. Now, the correct way of calculating this price to sales ratio would be to take the price for this ETF today divided by the last known sales per share for the trailing 12 months at that time. So that might be the trailing 12 months before the end of March, so going from March 2018 to 2019, and then taking that number and the price for today. I don't know if this is how they do it. It might be that they calculate the price to sales ratio for this date down here. So you have to take this with a grain of salt. I have written the contact person that I had in Morningstar, but he hasn't replied. But anyway, take it with a grain of salt. So let's go back to the spreadsheet. And the idea is that you click all of these links here, maybe once a month, or maybe if there has been a crash recently, you might go in here and look up all of these numbers again, so that we can get an estimate for if we invest in these stock indices, or ETFs rather, then what kind of return can we expect going forward 3, 5, 10 years. So we have a box down here that says the forecast for 3 to 7 year annualized returns, and we can look for the European index here. And given the price to sales ratio we just looked up and the forecasting formulas that I have just shown you, and let's go back to the Python notebook so I can just show you properly. So here we have for Europe 3 to 7 year returns, and we have the plot down here and the formula up here for the mean annualized return and the standard deviation. So we take these two formulas here, we go back to the spreadsheet, and those two formulas have been programmed right here with the parameters A and B. And we are also showing the R-squared value for how well it fit on the historical data. Now this table up here shows the assumptions that go into these forecasting formulas. So we have assumed an average sales growth of 0.3%, an average dividend yield of 4.0%, and a mean price to sales ratio of 1.04. So this means that if the future will be like these averages, then the sales growth will be almost zero, so it will not contribute anything to the future return. The dividend yield will contribute most of the future return, but because the price to sales ratio today is slightly above the historical mean, then it means that there's going to be a revaluation loss, and so the forecasted mean return will be something like 3%. It is an imprecise forecast, and the standard deviation around this forecasted mean is 5.9%. If you believe that the future will be different from the past, for example, let's say that Europe is going to go into a period of high growth. I don't think that is likely considering the political situation in Western Europe, but let's just pretend and say that in the future it will have 5% sales growth on average per year. Then you can just add 5% down to the forecasted mean here. And then you might say, well, in that case, it will also be justified to have a higher price to sales ratio. I don't know at this point in time how to estimate the price to sales ratio from, for example, the previous sales growth and profit margin and whatever else is necessary. It would seem reasonable that if we go into a period of higher sales growth and perhaps even better profit margins, then the price to sales ratio will go up as well. That is something we currently can't estimate. I don't have enough data to study that properly and say if there is a relationship between sales growth, profit margin, and price to sales ratio. But anyway, we have the same for the German index, Austrian index, emerging markets, and China. Remember from what I just explained a moment ago that for emerging markets in China, they seem to have different phases and it didn't fit the historical returns very well. So let's ignore those. And the last table here, we have the forecast for 10-year annualized returns. And again, the European index and the German and Austrian indices had very good fits on the historical data, but there wasn't that much data, so you should take this with a grain of salt. And even more so for the emerging markets in China, which have fairly decent R-squared values here. But again, it seems highly unpredictable what the future sales growth and price to sales ratio and so on will be for these markets. And that is what the forecasting model needs in order to make an accurate estimate of the future returns. So I wouldn't consider the emerging market and the China numbers here very accurate at all. But again, for today and going forward, it would seem that the European index, the German and Austrian indices will have fairly low future returns of around 3%, unless the future sales growth will be higher than it has been in the past, or unless we will have a significant revaluation with higher price to sales ratios. So a simple way of using this spreadsheet is that every month, when you have to invest money for your retirement funds, you will go into the spreadsheet, update all of these numbers up here. Maybe you are not interested in the German index and the Austrian index. maybe not even in the European. So you would do it for the indices that you're interested in. And then you would go down here and you would look at the forecasted mean return, first for 3 to 7 year periods, and then down here for 10-year periods. You would say, for example, S&P 500, low returns. No, I'm not going to invest in that because I believe that over the next 5 to 10 years, the sales growth and the price to sales ratio is going to be roughly the same as it has been the last 20 years or whatever. So it looks like we're going to have a revaluation over the following 5 to 10 years where the price to sales ratio will come down. It looks like the S&P 400, 600 and Nasdaq 100 is currently a quite good investment. Over the next 10 years, it looks like it might give something between 9 and 11%. So maybe I should spread this month's $1,000 investment or however much you want to invest this month and split it evenly between these 3 indices. But just before you do that, go up here and have a look at the assumption that goes into this forecast, where we can see that most of the return will actually come from a future sales growth. So if you believe that over the next 5 to 10 years, the S&P 400 for mid-cap stocks and the S&P 600 for small-cap stocks and the Nasdaq 100 for mainly technology stocks won't have so high sales growth anymore, then you can adjust the forecast down here by subtracting however many percents that you want. So this is how I would do the reasoning if I were to use these forecasts when I do investments. And as usual, you can download all of this by clicking on the links below the video.